Welcome to the Physician Sense Podcast, a podcast designed specifically for physicians, offering a breakdown of complex financial topics to help you develop your financial IQ, further your financial journey, and improve your well-being. Whether you're a medical student, resident, fellow, or attending physician, you're sure to learn something new that will benefit your journey. And now, your hosts, Chad Chubb and Tyler Olson.
Welcome to another episode of the Physician Sense Podcast. I am Chad Chubb. I have the fantastic, the wonderful, the one and only Tyler Olson as my co-host. And today we start to dabble in some open enrollment topics. You may be in open enrollment. You may just be coming out of it. You might be headed into it. As we know, it's a very busy time of year right now for a lot of physicians. So in today's topic, we're going to hit a little bit of health insurance, a little bit of the HSA, which is also known as the health savings account. Going to walk through some big ticket items you should keep in mind here. So welcome. Let's get into it. Tyler, two awesome topics, really a fun topic overall. I tell our clients all the time, I love open enrollment season. When you hear the terms health insurance, HSA, open enrollment, where do you start?
Well, first I want to take a nap because these topics and the research involved are extremely boring, but I recognize, of course, that they're really important decisions. And so if you feel the same way and you're thinking, I have 30 days to make this decision, especially some of you who are, like if you graduated training in June and you're starting August 1 and they're telling you you've got 30 days, or sometimes I've even seen it where it's like you've got 15 days to be able to make some decisions on your health insurance and other decisions. We want to impress upon you the importance of this because it will dictate the level of health insurance support that you receive. And you want to make sure that the decision is in line with your personal circumstances, both from a medical history standpoint as well as a financial standpoint. So I think the best thing to do when trying to determine first thing to do when trying to determine health insurance decisions is, what do I historically need from the healthcare system on a consistent basis? Am I someone who needs access to medication on a monthly basis? Am I visiting physicians and other providers on a more often than annual basis? Am I visiting specialists because of health issues that I'm dealing with? That's one end of the spectrum where you're using a lot of services. On the other end are people who go for their annual checkup and that's it. And then you might find yourself in between. So that's the first question I ask is, what are your health care needs? And then you can use that information to then filter the health insurance policy options that your employer's offering.
Yeah, one of the craziest facts I read, and this is by some time ago, I'm sure it holds true, if not even gotten worse, that the average American will spend more time planning a vacation than they will in their open enrollment on an annual basis, which is crazy to me because there's a lot of big ticket items in open enrollment. We're going to focus on health insurance today, but there's a lot of big items in there. And, you said it perfectly. And a lot of times when we start on this topic with our clients, it's that high level question. Physicians, we like pre-tax benefits. So then we kind of get into that high deductible health plan conversation so that we can benefit from the HSA. But it's not always that simple, right? If you're going to have higher healthcare needs, whether they're consistent or I always say the term like one-off, right? Like childbirth is one of the more expensive things that you're going to have pop up, like hopefully for most of us, right? And those things you can pre-plan for. So you might be able to say like, okay, well, we're planning on having a kid next year, and that might not be the best year to have a high deductible health plan. And there's a little bit of strategy you can utilize there. And obviously, there's always beautiful surprises that occur in terms of family planning. And sometimes there's not so good surprises. I use our family as an example where we had the high deductible health plan nailed. We had our child in 1 year. Then the following year, I'm like, you know what? We're going to be able to, I should say that the opposite. 1 year we're off of it, assuming childbirth, expensive year, probably not the best year to use that high deductible health plan. Following year, I'm like, we can get back on the high deductible health plan. We'll get that HSA going. And then once you know it, our middle child falls off the monkey bars, shatters his arm, has pins in his arm, surgeries, all that fun stuff. That one, we did not plan that one, right? So that was not a good surprise, but it just goes to show you the variability that comes in the decision-making process. And a lot of times it is nap-worthy material, as you noted so beautifully at the start there, but it's important. I mean, I would say taxes are the largest bill we have every year, but take taxes aside and maybe your mortgage, your rent. If you have a bad health year, you're tens, $20,000, $30,000 in cost if you didn't choose the right plan. And this is where, to this day, I should probably update some of my data on this, but I think one of the most common forms of bankruptcy is linked to unexpected healthcare costs. So that's why this stuff is so important. How do you look at the high deductible health plan, Tyler? What's your conversation with a new client when they say, well, Tyler, I'm a physician. I want to get the tax benefits. And then you start to kind of peel back the onion per se on terms of health questions. What's your conversation on, hey, high deductible health plan could make sense here. HSA is just an extra benefit to it.
I approach the health savings account qualifying plan, the high deductible health plan, from the standpoint of why shouldn't we choose that plan? Try to prove it wrong, because I love being able to use it if the health insurance policy that's supporting it is appropriate for the person. So trying to address the anticipated healthcare needs as well as their own personal risk assessment. We, from a pragmatic standpoint, you might look at someone's, history and what they say. I just go once a year, but maybe they have parents that have had health issues that can run in the family and they're anxious about that. There might just be general anxiety about having a really, really big, a very large deductible that would have to be met in a catastrophic situation. So I try to approach that carefully too, because it's not just about the numbers, but it's also about them feeling like they can sleep well at night. Kind of like investing, where you don't want to be investing without an emergency fund. You also don't want to be choosing a high deductible health plan without also considering, what sort of cushion you can have. And actually but see, that really bodes well for the HSA, because the HSA can function as your medical expense emergency fund. So let me just walk through briefly what the HSA is for anyone who doesn't know yet. It's a savings account that was created, 2008 or even earlier than that, maybe.
Yeah.
I can't remember, but it's a savings account that you can contribute to if you have a health insurance policy that is HSA qualified. HSA qualified or high deductible health plans, they have to meet a minimum deductible on the single coverage level as well as the family coverage level. But they also have maximums on the out-of-pocket expenses, the maximum out-of-pocket expenses. Because I've seen some health policies where I think that they would be HSA qualified, but their out-of-pocket maximum is higher than the high deductible health plan is, which is ridiculous because you would think that that would not preclude it from that sort of support, but it does. So you have to, when you're looking at your options, the different policies, they will either say HSA qualified or they will have the acronym HDHP, high deductible health plan. If it doesn't say that, you should not have confidence that it is HSA qualified. Anyway, you've got to have one of these health policies in order to have the HSA. And the health savings account is such that you can contribute up to, I think it's $8,100 for the family coverage and $4,050 for single coverage. Is that correct?
Is smidge higher. 2024 is $4,150.
Thank you. Okay.
8,300. I have my sheet in front of me. That's the only reason why I know that.
Thanks for having that. That's always, the numbers are always changing. Anyway, you can contribute up to that amount. So $4,150 as a single person, or if you're married and your spouse and you are covered, or if you are married and have kids, or if you are just you and your kids on the policy, those all qualify as family coverage. And then you can put up to $8,300 into this account. Now, if you do that, then you are able to deduct the contribution from your taxable income, which for many of you in medicine, many of you physicians, is something that you want to be able to do because you're in a high income tax bracket and you want to bring down that taxable income. So once the money's in there, then it can function as a savings account that is accessible to you for medical expenses. It's also something that if you don't use it for medical expenses, it is something that will roll forward to the next year. So you don't have to take the use it or lose it approach. That is applicable to the FSA, the flexible spending account. So if you are trying to determine the difference between the FSA and the HSA, that is one of the main differences, is that the FSA has to be used in the year in which you contribute to it. Was it plus maybe $500 you can use for the next year?
Yeah, they're adding more flexibility to the FSAs where they'll either do the $500 or now they give you a buffer window where they'll give you an extra 3 months into the new year. So it's gotten better, but you said it perfectly. That's the beauty of the HSA is it's good forever. You don't have to use it.
Mm-hmm. So it's a great source of emergency savings for medical expenses specifically. So if you're concerned about choosing a high deductible health plan because of the high deductible, the HSA account is designed to be a cushion for that. If you can afford, now this is also an assumption, but for many of you in medicine, you can create a plan to create savings where you would be able to meet your deductible fairly soon. Instead of just having that in a regular savings account, you could put it in the HSA, get a tax deduction, and then should you actually need to use it for healthcare expenses, you can draw from it tax-free. And that's including the interest that it may earn. Like our HSA, we've got our HSA at Fidelity. We got it sitting in a money market, at least the amount of money that meets this year's deductible. And then, of course, what's extra, we invest. So, yeah, and the investing component is awesome, don't you think?
Yeah, I think that's why the HSA is starting to get more of its shining moment. Not that I pick favorites, but if I had to pick favorites, I always say Roth IRA is my favorite. HSA is probably my second favorite. I still don't think it gets enough street cred. I think it's getting better, but the investing part of it, it's much more accessible today. I just was kind of taking some notes on things that we see. It's similar to the Roth IRA. When you hear the term investing, don't just assume because you put it in the HSA that it's invested. It's not. And we could probably have a whole nother conversation on how much cash do you keep, which is a common conversation we have. Some will keep, as you said, Tyler, for your family, the deductible, our family will usually keep a couple thousand in cash, not exactly to the deductible, but somewhere kind of in between, obviously zero and our deductible. And then we like to invest the rest of it. We have some clients that, I think some of the providers like HSA Bank, they almost always force $1,000 or $2,000. But then after that, clients are investing the rest. We have some clients that keep it all in cash. They'll sit there and they'll say, I don't know, maybe I will use it. Even though they're doing fantastic, we even have some cash aside. They're still like the idea of having that in cash. And then the exact opposite world of clients that are completely invested. So investing is an important one. Another error that we see a lot come tax time, you can't double dip on this one. So if you and your spouse both, let's just say it's a dual physician household and you both have HSA plans, you both don't get that 8,300, right? That's one number for both of you. So keep that in mind. That's one that we see every now and then. Another common error is if you switch employers, don't forget that your last employer wasn't tracking that number. So if you are watching this and you just finished your training, and let's just say you were using an HSA plan, now you're going to your attending role. Right now, you're picking those decisions. Remember, that number doesn't correlate, right? That employer, assuming it's not the same employer, will not tell your new employer that you already have $4,000 in there. Another beauty of the high deductible health plans with an HSA, a lot of employers will try to entice you to use this. So they'll also say, hey, we'll throw in $1,000, we'll throw in $2,000 to that HSA. So keep an eye on that. Now, this is one of those unique plans where that $2,000 counts towards your $8,300. So if they're putting in $2,000, you can now only put in $6,300, depending on when you're listening to this, watching this. Remember, 2024 numbers, those do change, but just kind of Google search the most recent ones. But I think those are some ones that we keep an eye on. I did Google it too, Tyler, where you're talking. 2003 is when the HSA joined us.
Oh, that's right.
Time flies. Yeah, so it's been around a little bit. One thing that we do with clients is, and I often will say in emails, I feel bad or Zooms or however we're hosting this meeting with a client, we will not tell a client exactly which plan to choose. Meaning WealthKeel does not say hey, choose this plan. What we usually try to do is get it down to a few options, explain the pros and cons. From our side of it, I always say my favorite number, again, don't want to be too broad speaking here, but with physicians, usually we're in a better spot, cash flow wise, number wise. I will usually come down to our clients and say, okay, the max out of pocket for this plan is 10 grand. The max out of pocket for this plan is 5 grand. All things aside, if you had the worst health year on record, this should be our stop. Are you okay with a 10,000 or a 5,000? Now it's much more detailed than that. We're trying to give them, I would say we want to give you all the details. You still make the final call, especially for something so vital, because here I am saying, hey, go choose the high deductible health plan. Let's hope they don't have a bad health year. Let's say they have a bad health year. And all of a sudden now a lot of money comes out of pocket. So we usually try to get it down to an organized list. But when you're looking at plans, at least at a high level, what's one of your favorite numbers? Is it the max out of pocket? Is it the deductible? Is it the premium? I know they're all important, but
the premium is not usually a big factor for two reasons. One, it's not like the budget of most people is not so tight, especially those who are out of training. The budget is not so tight that we need to worry about that. But the second reason is related to that. And that's because a lot of the premium costs through employed roles is pretty reasonable. They're usually, they obviously the costs do change and they vary, but that's not something, it's something that we make note of and say, hey, like this one costs this much per month and this much is this. When we do factor in total cost, we do address maximum out-of-pocket expenses plus premium, because the true worst case scenario is, well, this is how much the premium is and that you would have paid. And then if there is a catastrophe, this would be the worst case scenario. So we add those two together and then we compare that to other maximum out-of-pocket plus those premiums. So the maximum out-of-pocket comparison is helpful if it's informed by the premium cost, because usually the premiums are higher on the lower maximum out-of-pocket expense policies. So say it's like for a family, say it's like $700 for the lower maximum out-of-pocket cost. And then for the HSA, say it's like $400. So you're looking at a difference of $3,600 in premium. And if the difference hypothetically was like $5,000 versus $10,000, the true difference is only like $2,400 or not even $1,400 in that case. So it's not always that close, but you do want to, I like running both of those numbers together so that they can see the true cost of their choices. I agree with you. It's important that we leave the decision with each individual and family group because they have to take ownership of it. And I don't want to be in a position where I'm inadvertently recommending a riskier path than they're comfortable with. So yeah, just got to lay out the numbers and then let them decide.
Yeah. Especially like when you're working with a lot of young families too. It's not just like we know, mom and dad the best, but they have 3 or 4 kids too. They all have their own unique medical histories, and that's where it can get pretty complicated. And one thing as you were talking there again, with academic medicine physicians, I would say a lot of them are spoiled in terms of health insurance. The numbers are extremely low in terms of premiums. And one thing that I've noticed a lot of recently when comparing plans, I say recently, really the past few years, we've seen this happening now, is do that same math that you did, right? So say really good plan, $700 per month, high deductible health plan is $400 per month, difference of $300 per month, $3,600 per year. We've even noticed now, it seems like a lot of the employers, whether it's academic medicine or even private practice, that ends up being very close to the number that they're going to put into the HSA for them as well. So you might see that difference of $3,600, but now all of a sudden the employer is saying, but we'll throw in $3,000 into your HSA for you. Not saying that that's going to be perfect, but we've seen that gap get shorter and shorter and shorter. And those high deductible plans continue to look more and more attractive because of that. So that's kind of been a unique thing that we've seen. One thing that we always say, Tyler, especially for our physicians that are maybe a traditional W-2 employee, but then they want to go start their own practice, I always will tell them the biggest shocker you're going to have out of the gate is actually the true cost of health insurance when your employer doesn't cover any of it. And that's always that shock for our physicians or even our locums physicians, right? They're going to start, they're like, hey, I got to get health insurance. Where do I find that? And they're like, why does it say $2,000 a month? They're like, you got it, winner. That's yours. So, depending on where you're watching this in your medical career, that's why now it is a good tax benefit for you, but still health insurance is very expensive if you do not have a large employer picking up some of the slack there for you.
Yeah. I remember when early on in our marriage, my wife came from a family where they had worked, the parents had worked for a large company. Yeah. And I remember she was just shocked. She was like, wait, what's the copay? And I was like, copay? What are you talking about? Because even back then I was self-employed, and I've always been in this world of self-employment. So yeah, the multi-$1,000 premium, I'm like, oh, I don't like that. But I do like the tax. I do appreciate that we can deduct the expense from our, from our business revenue, but it's a lot more money. One other thing I wanted to mention too, for those of you who are age 55 and older, the contribution limits on HSAs are $1,000 higher. So if you're single and 55 or older, you can contribute $5,150. And if you're on family coverage, the contribution maximum would be $9,300 for that family coverage. So that's even higher. And for those that are counting, HSA contribution limits for 2025 will be $4,300 for self only and $8,550 for family coverage. And then presumably the $1,000 catch up for those of you who are age 55 and older. So something definitely to keep an eye on for the tax benefits. One thing too is like that, like we haven't talked about yet, is that the HSA essentially converts into a retirement account.
Yeah. Yeah.
I've only, just because of circumstances, most of the people that I presume you work with are younger. I've only had that utilized a couple of times in practice. But have you seen anybody do the thing like where they have not withdrawn expenses that were taken out like 10 years ago and now they're taking it out tax-free, like in retirement?
Yeah. So two things here. After age 65, which is what Tyler's saying, the HSA acts a lot like an IRA. But I had to add this in here because one of my favorite names in all finance, it's called the stealth IRA, one of my favorite terms of all time in personal finance. We usually don't get really creative in our industry. So that's one of the cooler names out there. But we call it the stealth IRA because anything you pull out after age 65, medical or just buying the Lamborghini that you waited on a long time, just all you're worried about is ordinary income tax. So when you think about it, you get a tax deduction going in, tax deferred growth while it's in there, and now you just pay ordinary income tax. If I describe that to you, most of you are going to say, oh, that's an IRA. Well, after 65, it's actually your HSA. So that's why it's a really neat tool. And then the other point that Tyler's making in there is you can collect receipts, right? You could keep receipts for the last 10 years and then go pull money out of the HSA and it'd be completely tax-free. So this is one where I'll kind of joke with our clients, like I probably wouldn't be stashing receipts away from CVS for $4 for NyQuil, but for larger expense items, throw them in an electronic folder somewhere, or if you're old school, a little file somewhere in the filing cabinet, but stash those away. That was a long-winded answer to your question, Tyler. No, we have not had any clients do that yet. Now, we do have some clients that could utilize this strategy. They have beautiful looking HSAs at this point, but, working with physicians, they're in a spot where ideally we don't have to tap into this until they would end up utilizing it down the road. That's the hardest part when we start talking about longer term financial planning. The biggest fear in a lot of financial plans is long-term care. And that you could be worth millions, and a bad long-term care event for either one or both individuals in a household can be devastating to a plan. So it's one where we've had the conversation with clients, and I think we got some excitement like, oh, we have these receipts. We could take that big trip on Uncle Sam's tab. Like we can do it. But no one's actually pulled the trigger yet. But I'm sure as time goes on, we'll have some better stories there. Do you have any have you even done the one where it's been old receipts, even if they're not 65?
Oh, like saving receipts?
Yeah, like from 3 or 4 years ago, and then clients go pull it out.
I do have a couple of clients that are they like that sort of minutia.
Yeah.
Personally, I think that it's a very subjective decision, because if you don't like messing with those sort of details, it's just annoying. And like, I think you really have to almost enjoy it to want to partake in that. And the individuals I'm thinking of, they really like that sort of process. They enjoy the details and such. So yeah, I have seen it, and it's pretty cool. You basically have the deduction from the contribution. It grows tax-free, and then you can just take it out tax-free as long as you have the receipts to back it up. You just take it out whenever you want to. And then in the meantime, it earned interest, and that interest is in there growing tax-deferred at least. And it's really cool. So if you're into that sort of detail work and like keeping records and such, it's actually very pragmatic. Yeah. But if you don't want to do it, it's okay.
Yeah. Yeah, you don't have to overcomplicate it. I mean, just the fact of getting an HSA up and running is a win. And like, I kind of made the joke there, like keeping big receipts, I think is the safer route there where, whether you consider a couple hundred or a couple thousand, but those are good ones to stash away just in case. Maybe use them, maybe you don't. But HSA, health savings account, high deductible health plans. The beauty is you get a restart every year. And this is why, I kind of started our clip here today on like, we love open enrollment. It's a chance for a fresh start in terms of very important benefits. So whether this is you working on your own, spend some time on it, talk to HR. If you have an advisor, most advisors love to nerd out on this stuff with you. We'll tell our clients, send us over that ugly HR packet that you don't want to read through, that open enrollment packet, send it to us. We'll send it over, we'll dissect it. I know Tyler does the same thing for his clients. So if you're already working with a great advisor, this is where we can help. So make sure you're taking advantage of that. But if you're not, just spend some time on it. Tyler, anything to add before we wrap up here on health insurance, HSAs, high deductible health plans?
I think we fairly well covered it. It's just important to base the decision on your personal health circumstances, personal risk assessment, and just to plug it in as a part of your larger financial planning process. So if you do that and take the time, then you'll make the best decision for you annually. And we won't dig into it today due to we don't want to overwhelm with too much information. But on the topic of open enrollment, you want to also make sure that you are reviewing your, retirement account options that your employer offers and group disability insurance and paid time off policies, any other benefits. Sometimes there's like some life insurance that's just paid for you. And it's good to make note of what those things are. They might just be like $100,000 or something like that. And you want to make sure that you just know everything that is available to you through this process. It is annoying and it might be a bit boring, but just dedicate a couple hours to it so that you can figure it out and then you're done with it. It is definitely important to invest this time and brain space. But yeah, I think that's it. We love the HSA if it's for a person and you want to take advantage of it if that's the case. But I love talking about this. We'll have to talk about other employer benefits sometime though.
Yeah, we'll keep building on this topic. As always, if you have questions, make sure you check out the website, physiciansense.com. We have a Google form on there. Drop a question in there. We're trying to continue to build in content around your questions. As we've joked since the very start promo for this, we're here for you all. So send us questions, whether it's comments on our YouTube video or going to the Google form and dropping us a question, please do. And we'll keep building around your questions. Tyler, thank you. I'll catch you on the next one.
See you around.
This information is for general purposes only. This information is not intended to be a substitute for specific professional, financial, or tax advice, as individual concerns vary. Please see a financial professional, CPA, and/or an attorney in regards to your own individual situation. Wealth Heals Advisory Services and Financial Planning offered through Vicus Capital Inc., a federally registered investment advisor. Olson Consulting LLC, offering advisory services and financial planning, is a state-registered investment advisor.